Hey everybody, my name is Dr. Brian Winrow. I'm a tax professor and a tax attorney, and today I'm going to be talking about liquidating distributions. So, liquidating distributions is a concept that trips up a lot of people, whether it's students or people that are getting ready to sit for the CPA exam or the enrolled agent exam. So, my goal here is to make liquidating distributions a little easier to understand for you. So when you take your exam, whether it's in class or it's getting ready for one of our professional certifications, you can take it with confidence and you can do well on this section. So in order to do that, we first need to understand what is a liquidating distribution. Then we need to go through and figure out the ordering rules. Then we need to determine how do we calculate what's going to be called earnings and profits because that's going to relate to dividends. And then we'll go through and we'll start looking at some examples so we can calculate this. Okay, so the first thing that we need to know is when you were talking probably in business law or maybe some of your financial accounting courses, it's often presented as though a corporation is making this money and then they have it at the end of the year. They've got this net income, they've now paid their taxes, and they have to decide what they want to do. And oftentimes it's presented as though the options are you either pay a dividend or you retain the earnings. Okay. Well, we're going to be more specific than that because when a corporation makes a distribution, such as a possible dividend, we need to determine if it's actually going to be a dividend or whether it's going to be classified as something else, like a return of capital or capital gain, because that's going to dictate the tax treatment that we have. So that's the purpose of this video, is to understand those rules and to get you ready for this exam. All right, so now that we know the basics, let's go ahead and start looking at this, make sure that we're going to be able to calculate this so you're going to be in good shape. All right, so we're dealing with a non-liquidating distribution. All that means is that we're still going to be operating, the corporation is not shutting down and the shareholder is not going anywhere. Otherwise, we're looking at something like a liquidating distribution, and I'll do a video later on a liquidating distribution. But right now, this is a fully functioning corporation and our investor is committed to this business. So we have a non-liquidating distribution. Now, when we have a non-liquidating distribution, we have to classify what type of distribution we have. And we're really going to have three options. And there are ordering rules that we have to follow. We don't get to just choose. So the first one is going to be this dividend, right? We have a dividend. Now, a dividend is going to be taxed at our preferred rate. If it's a qualifying dividend, we're going to be taxed at either 0, 15, or 20%, far better than our ordinary rate, which could be something as high as 37%. So a dividend is not all bad, but we only have a dividend to the extent of what we have known as earnings and profits, right? And earnings or profits are basically the capacity that the corporation has available to make a dividend payment. Now, a corporation can still make a distribution even if it exceeds its earnings and profits, right? The only thing is, if it makes a distribution that exceeds its earnings and profits, it won't be called a dividend. The portion that exceeds earnings and profits is going to be called a return of capital or a capital gain. Now, we're going to work through this. So that may sound a little bit confusing, but we're going to work through a lot of this. And these are initial concepts that we have to throw out there so we can build upon. Okay, so we have dividends to the extent of earnings and profits. The next video portion of this is going to be looking at what is earnings and profits and how do we calculate our earnings and profits. So that'll be the next portion of it. But the first part of a distribution is dividends to the extent of earnings and profits, and we'll look at those rules. The second part is going to be our return of capital. So the return of capital is just recouping your previous investment. So your capital is marked by whatever your basis is. So when we have a return of capital, all we're doing is we're taking back our investment, our basis. So for every dollar that we have of return of capital, we have to reduce the basis until the basis is zero. So returning of capital will reduce our basis. Because basis signifies what our investment was, so we've already been taxed on that portion for the basis component. Then as we start to recoup our basis, the return of capital is not going to be taxable. So to the extent of basis, we call it return of capital, and that's non taxable, right? And we'll continue to label it as dividends to the extent of earnings and profits. After we're done with E and P, then we go to return of capital. We'll continue to list all the distribution as return of capital until our basis hits zero. And if we still received more distribution than our E and P and our return of capital, then we have the rest of it will be known as a capital gain. And there's no limitation on how much capital gain. It's just, I guess the only limitation would be the extent of our distribution that we received, right? So we always start out with dividends and we look to see where the earnings and profits. Then after earnings and profits, we say it's a non-taxable return of capital, reducing basis all the way down to zero if we need to. And then we go to capital gain. And with the capital gain, that is also going to be taxed at 0, 15, or 20%, so our preferred tax rate. Now let's go ahead and start understanding what earnings and profits is so we can make the computations, which you'll see on the different exams that you're going to encounter. So let's talk about our general distribution rules for a non-liquidating distribution. So what we're looking at on your screen is we have current, accumulated, treatment, and distribution rules. So we're dealing with earnings and profits here. Now, when we deal with earnings and profits, there are two different components of earnings and profits. The first component is going to be called current earnings and profits. And current earnings and profits, we're looking at the current year, how much money did the business make that it can then distribute in terms of a dividend. So we're looking at a 1 year period. Think of a current E&P, current earnings and profits. Think of it as a temporary account because what we're going to do at the end of the year is we're going to close any balance that we have in current, we're going to close that over to the accumulated balance. So accumulated is looking at it from the life of the business. So we're going back and we're saying, all right, how much in income or losses has this business had over its life? And is it a positive or a negative balance? Right? So if we've had many bad years, maybe we're a brand new business, we're having many bad years, we haven't turned a profit yet. Well, if we've been losing money for the last 3 or 4 years, in the first 3 or 4 years, then our accumulated is certainly going to be a negative amount. It's going to be a deficit, right? But then maybe we start to turn a profit. We finally started to get a profit. We've got our name out there. Now we're making a profit. Well, now we have a positive current. And if we don't distribute that positive current at the end of the year, we close that positive amount into accumulated and it will reduce the deficit we have. So if we had a deficit of 300,000 for accumulated, and in the current year we had a positive 100,000 for current and we decide not to distribute it, well, what's going to happen is we're going to go ahead and we're going to close out our current into accumulated. And instead of having a deficit of 300,000 in accumulated, that will be down to 200,000. Okay. And then our current at the beginning of next year will be zero. So we're closing it out as we go through. Now, what we're talking about for accumulated and for current E&P, so E&P in general, is it's the ability of the corporation to make distribution payments as dividends, right? So it's based basically on their earnings that they have, the cash that they have available to make those types of distributions. Even if they don't actually have that cash on hand, it's still their earnings and profits. Okay, and that's what we classify as a dividend. But it doesn't necessarily mean that they can't make a distribution beyond earnings and profits. So that's why we have to go through these rules. So let's look at the 4 situations that can arise when we're dealing with E and P. So if we have current and accumulated, right? Current year or over the life of our business, what we could have is a positive year in the current year, and that would be a positive. So we have a positive and an accumulated, we have a positive. So we've been positive for several years. So we have a positive and a positive. Okay. A positive amount for current, a positive amount for accumulated. What happens is we treat that as a dividend to the extent of earnings and profits. So we'll take the current and accumulated, and all of that will be their dividend earning capacity. So if we had, say, $50,000 of current in the existing year, right? We have $50,000 there, and then we have 100,000 for accumulated, and we make a distribution of 100,000. Well, if we had 50,000 plus 100,000, that gives us $150,000 of distributions we can make that will be classified as a dividend. If we made a distribution of only $100,000, well, that 100,000 is less than our dividend paying capacity of 150,000. So it's going to be a dividend for the entire $100,000 distribution, right? And what will happen at the end of the year, because we've only used 100,000 for the distribution, at the end of the year, we'll have $50,000 remaining in accumulated because this was 150. We'll have $50,000 accumulated. All right, let's look at the next one. Let's look at current as a positive and accumulated as a negative. So this could be like a new business, and we've had many years of bad luck. We haven't broken a profit yet. And we finally came through this year. This was the year. We did it. We have a profit. All right. So now we have our profit. We want to reward our shareholders for staying with us. Thanks, guys. We're moving forward with you now. We've earned some money. We're making a distribution. All right. Do not net, right? You see this? Do not net. It's important that you remember this. Do not net. If we have a positive in current and a negative in accumulated, do not net. What's going to happen is just ignore this part. Okay. It's going to be a dividend to the extent of our earnings and of our current E&P, our current earnings and profits. So dividend amount to the amount of current. Okay. So in my last example, I said, imagine that this one was actually 50K, right? So we had 50K, and then I think I said this one was $100,000, and I said it was a positive. Well, now imagine that this is going to actually be a deficit of 100,000, and this one's going to be positive 50. Well, if we still have our $100,000 distribution, what's going to happen? All right. Well, if this is still $50,000 are going to be our potential dividend. So we would have a dividend of $50,000. All right. I'm going to show you these other distribution rules here in just a second. Let's just stay with our basic rule now, and then we're going to hop over here and we're going to see what we mean by this distribution rule. So now we've dealt with a positive and current, a positive and accumulated, a positive and current, a negative and accumulated. Now let's reverse the rules. Now we've been successful for many years, but something happened. Something in the economy, it sank on us, prices went up, our market became obsolete, whatever it is. We've had many positive years. It's been great, but this year we struggled and we have a deficit. All right, if you have a deficit in current and a positive in accumulated, this is the only time that you're going to net. So this will be the only time that you net a deficit in current and a positive in accumulated. So net. And what we mean by netting, because students sometimes, they hear that all the time through the curriculum, but then they're like, what do they mean by netting? Basically, we're subtracting these out, right? We're going to subtract them out. And if our positive accumulated balance is greater than our current deficit, we have a dividend to the extent of the excess balance of accumulated. So after we cancel out all of our current, so if we had, say, a deficit of 50,000 instead of a positive here, we had a deficit of 50,000 in current, and here we have a positive 100,000. We'll subtract 50 and the 100. That'll give us 50,000 remaining. That 50,000 is going to be considered a dividend. So that's what we would use as our dividend portion of it. All right. So now we're looking at this final one, which is going to be a negative and a negative. That's a simple one. If you have that one, you're doing good. You don't have to really worry about much because that one's going to be no dividend. So you'll be excited if you see that one on the exam. It's no dividend. We go straight to return of basis, so return of capital or capital gain. All right. So I put return of basis, but it's reducing our basis, so return of capital or capital gain. Okay. All right. So let's look at these distribution rules. And we're going to work through a lot of examples so you get to see them, especially with the pro rata, because sometimes this one confuses students on what do we mean by pro rata. But if we have distributions that are made at different times during the year, well, we have to figure out under each distribution how much of the distribution comes from current E&P and how much comes from accumulated E&P. All right. So our rule is for current E&P, we pro rata it. So we're going to look at the total amount of distributions, right? Time divided by the percentage, the amount that was actually paid on that first distribution to get to a percentage, and then we'll multiply that percentage times the current E&P. It sounds complicated. It's not bad. We're going to work through numerous examples, and I'll make sure you have that concept down when we get there. All right, so just know for now, pro rata for current. Accumulated, we use chronological. Okay, so if you have two distributions, it's possible that the distribution made in March will have more of the accumulated E&P than the distribution that was made in December, right? Because that's not based upon the percentage or the necessarily the amounts. It's chronological in order. And again, we're going to work through these examples. It's just trying to get to understanding that we have chronological for accumulated and pro rata for current. Okay, after we've gone through and we've determined what amount is dividends, so we've dealt with all of our accumulated E&P, then we do return of capital until we have a basis of 0, and then anything remaining is going to be a capital gain. So notice this. If you have a capital gain, if you're saying that there's a capital gain, that means your basis has to be 0. It has to be. Okay. Otherwise, there's no way that you could even have um, a capital gain because it would be a return of capital. So until basis is 0, you don't have a capital gain. Once basis is 0, any additional distribution, now we're completely capital gain. All right, y'all. I hope you're hanging in there with me. I know some of the concepts still pretty abstract right now, but when we get to the examples, you're going to be pretty good with this. Before we can get there, I've got one more hurdle that we've got to get through. I won't spend a lot of time on it, but what we need to do is we need to figure out how do we even determine if we have any E&P. So what is used to determine the amount of E&P? And we're going to go ahead and we're going to do that now. All right, so let's go ahead and let's figure out how we calculate earnings and profits. So as we're going through here, what we need to do is we need to recognize we start with the adjusted taxable income. So that's our starting place, right? Adjusted taxable income. So once we know what our adjusted taxable income is, we're going to have 4 additional adjustments that we have to make to it. So the first adjustment is we're going to include in earnings and profits certain amounts that were excluded, that were previously excluded. So what does that mean? Well, when we were trying to get to our taxable income, what we said is there's certain things that we don't want to include in taxable income because we're not going to be taxed on it. And the key two of them that are most common is going to be your municipal bonds, so state and local bonds, because those are not taxable. If we included it in our taxable income, we would have been taxed on it, right? And then life insurance proceeds. So if we had life insurance proceeds on an executive in our business and the executive died, well, life insurance proceeds aren't going to be aren't going to be taxable. They're not included in our gross income. So we don't want to go ahead and include that amount. So when we were getting to taxable income, we said, okay, those are not going to be included in our adjusted taxable income. So we never included that. Well, that's great because we don't want to be taxed on it. But here we're not determining how much we're going to be paying in taxes. Instead, what we're doing is we're going through the process of trying to figure out how much money we have to pay dividends. So, do we have that cash? Because if we have that cash can be used to pay dividends, right? So, we can use the cash to pay dividends. So, yeah, we have cash. It's in our bank from the municipal bonds and from the life insurance policies. So, add those to adjusted taxable income. That's the first thing. Add those two back to taxable income. All right. Well, also, when we were getting to adjusted taxable income, there were certain types of expenses that were used to get to adjusted taxable income that we were allowed to take, but we didn't actually spend money on it. They're more paper deductions, right? So let's look at some of those. Dividends received deduction. We had money that came in, right? So we had that money. And then we said, oh, well, we wanted to have a DRD, a dividends received deduction. So we took out a certain percentage of it. Well, that's what we're talking about here. We didn't actually pay anything for this deduction. We excluded some. So we're gonna have to add that back in. Our net operating loss carry forward. So we had an operating loss 2 years ago. We were carrying it forward indefinitely. So now we get to use that net operating loss. Well, you know what? We used it to get to taxable income, but we didn't have to pay it. No money left. We experienced that loss a couple years ago. In the current year, we didn't lose anything. We just wrote that off. Net capital loss carry forward. So we previously had a net capital loss. That was when all the hard portion of it came through. Now we're carrying it forward. So 2 years later, we're now using it. Well, guess what? We didn't actually spend any money. That money's still in the bank. It was just a paper write-off for us, right? Organizational expenditures. So we get to expend up to 5,000 in the first year. Limits at $50,000. Phase out dollar for dollar, so between $50,000 and $55,000, and then you amortize the remaining portion of your organizational expenditures over 180 months. So what does that mean? Well, what it means is in those other months that we're amortizing it, we're not paying it out. So all of these in part two, none of those were expenses where we wrote the check. The money's still there. If the money's still there, then we need to add it back into our adjusted taxable income so that way we know we can actually pay this out. We can pay a dividend. We have that capacity to pay the dividend. So the first two, right, number one and number two, those are going to be things that we add back into our adjusted taxable income. Now we get to number three and we deduct certain expenses. So here in number three, we're going to subtract certain expenditures that requires an economic outflow but are not deducted for computing taxable income. So it didn't show up in our taxable income. All right. Let's look at some of these. Entertainment expenses are not deductible. Well, we still wrote the check. We did that for for our financial records, right? Meals, we only get 50%. So we didn't get the full 100%, even though we paid 100%. We paid our taxes back, right? So we had to pay our federal income taxes. We wrote a check. We don't have that money anymore. So we don't have the money for entertainment expenses or meals or taxes, or if we were speeding or get a fine with our business, those aren't deductible. So because they weren't deductible, it doesn't get reflected in our adjusted taxable income. But on all of those in section three, we actually paid money. So we don't have that money that we can use for dividends. So we have to subtract those out from our adjusted taxable income to better understand what our earnings and profits are. So that's why we're subtracting in three. We added in one and two, subtracted in three. Number four is a timing difference. It could be added, it could be subtracted. The easiest way to look at that is going to be depreciation, right? Did you take makers and then it evens out with the straight line? So, are we taking, adding it, or subtracting? That's what number four is. It could be an addition, it could be a subtraction. Now, in these examples that I provided, those are just a few of the more common examples. There are far longer lists than this, but I wanted to give us at least a foundational understanding of what it is that's going into earnings and profits. And hopefully it helps you understand, well, see, earnings and profits is the amount of money that we actually have to make those distributions, right? So it's not taxable income, it's not net income, but it's the IRS's way of saying, hey, how much of it is your dividend paying capacity? So that's why we're making these adjustments that we wouldn't have been able to deduct for tax purposes. We still don't get to deduct for tax purposes, but it tells us what we can do as far as labeling it as earnings and profits. All right, guys, I hope this is helping. So what we're going to do now is we're going to go ahead and we're going to start looking at scenarios. And I've created 5 scenarios for you. And I tried to draw out some lines so you can see where the dollars are coming from. But I'll walk you through the calculation of each of these scenarios. And then I'll try to put each scenario into a specific chapter within this recording so you can skip around if you're feeling comfortable with one and you have to come back and revisit this video. You can skip around to where you need to be. All right, so let's head on over there and we will do another one. All right, so we're finally at the problems. So let's make sure that you have this down. Like I said, you're going to get through these with confidence. What I did is I created some problems here, and you can see down at the labels for the different pages that I used what we're dealing with. So this one's going to be a positive and a positive, right? Which means a positive for current and a positive for accumulated. So we have Sunny Pizza Inc. has current earnings and profits of 120,000 and accumulated earnings and profits of $200,000. It makes two shareholder distributions, 100,000 in June and 300,000 in December. Assume the basis is $20,000. How much of each distribution is a dividend, return of capital, and capital gain? And then I put on here, note this problem is both positive current and accumulated E&P, just so we can make sure. Now, in your exam, it's not going to tell you that they're both positive. And oftentimes on an exam, you might just have one distribution at the end of the year, which really simplifies things. But for us on this one, we're going with multiple distributions. And the reason I went that route is I want you to be able to do the pro rata approach to understand how pro rata works. So let's look at this. The first thing we have to do is we have to say, okay, we have a June and December distribution. We have our shareholders. We weren't provided with the shareholder names. That's fine. Um, so then what we have is distributions of 100, 300, and 300,000. And we were given that information. It makes two shareholder distributions, 100,000 right here. And then we have our 300,000 right here. So 300,000 in December. So I put 100,000 in June, 300,000 in December. All right. So what we know then is our total distributions made throughout the year is $400,000. That's going to be important because what we have to do is we have to figure out what portion of current E and P, because remember we do pro rata with current, what portion of our current, our $120,000, is going to be applied to the June, and what portion is going to be applied to our December distributions. All right, so if we had 100,000 in June out of 400,000 throughout the year, what we're going to do is go 100,000 divided by 400,000, and that's going to tell us 25%. And then if we take 300,000 divided by 400,000 for December, that's going to tell us for December we have 75%. So what we're going to do is we're going to take 25% of the current E and P, and we're going to allocate that to the June distribution, and we're going to take 75% of current of 75%, and we're going to multiply that by our $120,000 of current E&P. And that's going to give us 90,000. And you can see the math that I did right down here. So $120,000 of our current E&P, and if you follow that red line, you'll see where I got it from. And then the 120,000 times 75%. And again, there's our 25 and our 75%. All we're doing is a distribution divided by the total distributions to figure out that percentage. So if we take that 120,000 times 25%, 30,000 of our distribution, our current distribution, will be allocated to June, 90,000 to December, and that gives us 120,000, which means we have taken care of all of our current E&P. So that's all good. And it should equal out that way, right? All right, so we've now dealt with this. This is all going to be dividend. So we know the current E&P is going to be dividend. But now we have chronological, or the accumulated portion, which we're going to use in a chronological method. So we've got to go through and figure this out from a chronological method. So we have accumulated earnings and profits of $200,000. All right. Well, we do it in chronological order, which means all 200,000 theoretically could be applied to your June distribution. It might not have any left over to December because we're going to exhaust as much as we can in June. All right, so we know we have $200,000 of capacity, but here's the thing. We only had a $100,000 distribution that was made in June. We've already accounted for 30,000 of it. So if we go 100,000 minus 30, that means there's only $70,000 of that distribution that we have not accounted for yet. So what we're going to do is we're going to say, okay, we have 200,000 of accumulated E&P, but we only have to account for $70,000 of our 100,000 distribution. So all 70,000 is going to be accumulated for the June portion. So we've now dealt with June. We had a $100,000 distribution, 30,000 is current, 70,000 accumulated. Our total dividend's $100,000. So everything in June is a dividend. Now, after we've dealt with the 70,000, we said, okay, we had 200,000 of accumulated. We've now taken care of 70,000 of it, which we apportioned to the June distribution date. That means we have $130,000 remaining of accumulated. So the 200,000 minus the 70,000 that was apportioned to June gives us 130,000 remaining. Well, we still have, if we look at this, $300,000, 300,000 distribution, $300,000 distribution, minus the 90,000 that was current for December, minus our 90,000. That means we still have $210,000 of our distribution that we have not yet accounted for, and we still have $130,000 of possible accumulated E&P. So what we're going to do here is we're going to take that 130 and say, well, let's just use the rest of our 100, let's use the rest of our accumulated E&P, right? So now what we've done is we've used 70,000, 130, and that means all 200,000 was used. We're done. We've now dealt with all of our current and accumulated. So our total dividend will be 30 plus 70 equals 100. 90 plus 130 equals 220. All right. So that's our dividend income. Well, if we look here, we knew we had a $100,000 distribution. We've handled all of it. We had a $300,000 distribution in December. We've only handled 220. We still have $80,000 remaining. Okay. We still have $80,000 remaining. So in June, since we dealt with just dividends, there's no return of capital. There's no capital gain. The basis is down. It's zero there. So we didn't have any impact on our basis. So what happens is out of that 300,000 minus the 220, we have 80,000 remaining. Our basis is 20,000. So we have a return of capital to the extent of basis because we reduced basis. So we're going to exhaust all $20,000 and that's going to be our basis right here of 20,000. So we'll take basis down to zero. So our basis is going to eventually be zero, but we're using all of our basis. So now what we've dealt with is dividends of 220 plus $20,000 of basis, return of capital, I should say. So that's 240,000. Anything left has to be a capital gain. So a $300,000 distribution, $240,000 of distributions already leaves us 60,000. We're going to call that 60,000 a capital gain. Okay. And if we do 60 for return capital gain plus 20 for return to capital plus 220, that will equal your $300,000. So we handled it all. Okay. So we know we're going to be correct on that. So our answer here is going to be how much is going to be a dividend? Well, our total dividend, right? Our total dividend is going to be right over here. We're going to have the total dividend of 220, right? And then we're going to go through and we're going to also have our dividend of $100,000 there. And that gives us 320,000 total dividend. So we could type that in there if we needed. 320. Okay. And if we look at that, 120 plus 200, that will equal us $320,000. So we know we're correct, right? Because we've dealt with all of our dividend. Our capital gain, or our return of capital, which is non-taxable, is 20,000, and our capital gain is 60. All right, guys, I hope this problem helps. It might take some time looking over it, but this will walk you through the process. So I'm going to go ahead and I'm going to move over and we're going to talk about a situation where we have a positive in current and a negative in accumulated. Remember, this is one we do not net coming up. So just keep that in mind. We do not net. All right. So like I said, this is one where we're not netting, and this is going to be the first of a positive negative that we're going to do. We have two problems with these. So the first one, let's read the facts. Lucky Company has current E&P of $100,000 and accumulated E&P of a deficit of $50,000. It distributes $130,000 to its only shareholder, Sarah, on December 31st. Sarah's basis is $10,000. The question is, how much is dividend, return of capital, and capital gain? And again, this is telling us we have a positive for current and a negative for accumulated. All right. So one distribution date of December 31st. So we have December and we have one shareholder, which is going to be Sarah. Okay, well, this is going to make it a little bit easier for us, right? This makes it a little bit easier for us. So let's go ahead and look at this. We know that when we have a positive and current and a deficit over an accumulated, we're going to ignore our accumulated portion. We don't net them together. So in this situation, we don't have to worry about that. So what we can do is we can come through here and we can get rid of the $50,000, right? Because we're not worried. Now we're worried about it for what's going to happen at the with the remaining dollars on it. I mean, when we close things and if we have to close anything, it doesn't change our accumulated at the end. So anyway, let's look at this. So we have our distribution of 130,000. We have current E&P of $100,000. So we have a potential of $100,000 worth of dividend, right? We have a potential of $100,000 worth of dividend. And that's exactly what we're going to get here. Okay. So if we look at this, we can see, hey, look at, we have current of $100,000 to the extent of it, right? Because we're not netting them, it's current to the extent. So we have a current dividend of 30,000 from current E&P. There was no accumulated that we can use, so our total dividend is going to be $100,000. But we have $130,000 of distribution because that's what it tells us. So we have $130,000 of distribution. We've used 100,000, so we have 30,000 remaining. Of that $30,000 that's remaining, we next go to return to capital. Return to capital to the extent of basis. Well, we only have $10,000 of basis, right? And if we only have $10,000 of basis, well, then we can only have $10,000 of return of capital, and that will knock our basis all the way down to zero. So we're going to have $0 for basis remaining. All right, now that basis is zero and we've only dealt with 110,000, 100 plus 10 of the $130,000 distribution, that means we have $20,000 remaining. Well, if basis is already zero, anything else has to come from capital gain. So we have a capital gain over here of $20,000. And if we want to check our math, dividends is 100,000 plus 10,000 for return to capital. plus 20,000 capital gain. That's $130,000. Yeah, that's the amount of distribution. Our basis is zero. It'll always be zero if we have anything in capital gain. And then our accumulated E&P at the end of this year is still going to be a deficit of $50,000. We didn't have anything left over in current to close out. We exhausted it all because we distributed all of our current with that $100,000. All right, Joe, that's the second of five that we're going through. So the next one is going to be a second positive and negative. So a positive in current and a negative in accumulated. So let's go ahead and take a look at that one. So here we are. We're on our positive and our negative. This is the second problem. I added this one because I wanted you to, again, see two different distribution dates so we could go ahead and we could go pro rata with the current amounts. So we have Ace Corp has current E&P of 90 and accumulated E&P of a deficit of 200,000. It makes two distributions to its only shareholder, Brett, 50,000 in June and 100,000 in December. Brett's basis is 10,000. How much do we have in dividends, return to capital, capital gain? And again, this is a positive current, negative accumulated. All right. So we know that on this problem, we only have, get this going for us. We only deal with current. We're not dealing with our accumulated because we're not netting these out. So we have $90,000. So how do we determine how much to apportion for our $90,000 on each distribution? Okay. Well, it tells us that we had a $50,000 distribution in June and $100,000 in December. So we have 150,000 total distribution. 50 of that 150 came from June. So if we go 50 divided by our 150, and I rounded down on this, but it's 33%, right? And then we had 100,000 in December, and it told us that. It told us there's $100,000. 100,000 divided by our total distributions for the year, 150, tells us we have 67%. So of our $90,000 of E&P, current E&P, 33% is going to be allocated to June. So 29,907, and that's what I put right up here for you. 29,700. And then 90,000 times 67%, right? That gives us 60,300. There we go. And when I add those two together, it shows that I'm dealing with, oops, sorry about that. I'm dealing with all $90,000 here, right? I'm dealing with all 90,000, which is what I should be dealing with. Great. We've handled all the current E&P. That was it. We went pro rata. We've allocated it to the portion to the right place. And then we said, well, how much for accumulate? We didn't have any accumulated. It was a deficit. So nothing we could do there. So our total dividend is 29,700 for the June, 60,300 for the December, which gave us the $90,000. Great. But we had a distribution of 50,000. We've only handled 29,700, which means we still have to account for $20,300. All right. Well, what are we going to do with that? Well, let's go to basis. There's $10,000 for our basis. We have $10,000 for our basis over here. Okay. So we're going to take the full basis. That's going to be $10,000. So of that 20,300 remaining, 10,000 is going to be basis. So we call that return of capital. Our basis will become zero. We don't have anything left for basis. And then when we look at 20,300 right here, minus our $10,000 of basis, we still have $10,300 remaining. Well, anything remaining is going to be a capital gain. Anything after basis is zero has to be a capital gain. So we have $10,300 of capital gain. We're doing good. We're doing good. All right. So let's look at this one with the December. There's a $100,000 distribution, but we've only dealt with 60,300. Well, 100,000 minus 60,300. Okay. That means we still have $39,700 left. Well, we've already used all of our basis, so there can't be any more return of capital because basis is all the way down to zero. But guess what? We have our capital gain of $39,700. So a total of $50,000 is what our capital gain is. And if we want to check this, there should be $150,000 of distribution. If we go 90 plus 10, so 90,000 in total dividends plus return of capital, 10,000 plus 50,000 of capital gains, it's 150,000. We've accounted for all $150,000 of the distribution. Good signal that we did this correct. All right, two more problems, y'all. We're almost there, so hang in there. Two more problems. Now we're going to do the negative positive, okay? And then the final one's easy. It's just negative, negative. We'll blow through that one quick. But now we've got to do the negative and positive. Remember, this is the one where we're going to net. So let's go ahead and take this one on. All right, guys, so here we are. We're doing the amount where we have to net. So if we look at this, we're going to have Tally Corp as current E&P with a deficit of $50,000 or a negative amount of 50,000. Accumulated E&P has a positive amount of 200,000. In December, it distributes 150 to Kylie, the sole shareholder. Kylie's basis is $220,000. How much is dividend, return of capital, and capital gain? So let's work through this problem, right? So what we're looking at right here is December, Kylie, the distribution is $150,000. Well, we have to figure out after we net how much is our dividend paying capacity. Um, 50,000 and then we have 200,000. When we net them out, it comes out to 150. So if we look at this, we have 150,000 of dividend paying. That matches our whole distribution. We have nothing left over. We're done with it. We got it correct on that. Okay? So all of our distribution has been handled. So that means we have a return of capital of zero. Our capital gain is zero. This is not going to be correct. So our answer for our remaining basis is going to be $220,000, right? That should have been 220 because what we're dealing with is the only way we reduce our basis is if we had a return of capital. We didn't have a return of capital, so we have to go $220,000 as our correct answer. So what we're going to have total is a distribution of 150,000. We're going to have that as a dividend. It'll be taxed at 0, 15, or 20. It doesn't harm our basis because it wasn't a return of capital. Our basis is going to remain unchanged at $220,000, and we've solved this one. All right, let's look at one more. One more, y'all. And we will then end this recording with that final one. All right, y'all, this is our last one. And what we're going to do is we're going to go through and we have a negative and a negative. So we have Broke Incorporated has current E&P of a deficit of $100,000 and accumulated E&P of 200,000. So Broke Corporation has no money. They're broke. A deficit on each of them in December, it makes a $50,000 distribution to Brittany. Brittany has a basis of $40,000. All right, so we have a December distribution from Broke, and we have Brittany as our shareholder. The distribution, like I said, is $50,000, which it tells us. Well, if we have a deficit and a deficit over here, right? We have a deficit there and a deficit here, then there is no dividends. We don't have anything to pay for the dividends. So no E&P. So we'll have zero for our dividend. And then what we're going to have is a return of capital to the extent of basis. So we're going to use all of our basis right here because we have a $50,000 distribution, 40,000 for basis. So we're going to be limited to $40,000. That means we have $10,000 remaining right here after the 40,000. So of our 50 distribution, we're going to have 40,000 as a capital gain. The remaining 10,000 is, I'm sorry, let's try that again. That $50,000 distribution, 40,000, which is going to be return of capital. $10,000, which is going to be our capital gain. We've reduced our basis all the way down to zero, as it shows in the capital return of capital component of it. So pretty easy when we have a negative and negative because we're not going to have any dividends. We just jump straight over to return of capital to the extent of basis. And then anything after basis has been reduced down to zero has to be a capital gain. And we're finished with that. All right, guys, I hope this one helps you. I hope this video has been helpful. E&P is not the easiest topic, but working through these types of problems is the way that you're going to be able to master this concept. Good luck as you continue to prepare for your exams, and I'll get some other recordings out there for you to help you with other complicated areas. In the meantime, if you will, subscribe to my channel for additional topics on tax-related issues, especially as you're preparing for exams and trying to learn these initial concepts.